My children, even though I look 12. You probably heard of this thing called the stock market, and it's seen as this big elite thing that gets discussed at those fancy dinner parties with adults, you know, where they drink like mimosas or whatever. But I'm here to tell you that it's not necessarily this big elite complicated thing as you think it is. And a term you hear even less is this thing called bonds. So I'm going to just lay out all the definitions. I'm by no means a financial advisor. I'm just gonna dumb the details down for who maybe not have a very general or detailed understanding. And from there, you can do whatever you want with the information. Okay, so let's get some key details in. There's this thing called the stock market, as I said. So let's take Google, for example, and let's say they wanted to raise capital for their company. There's something called an IPO, which is called the initial price offering. This is where Google pays a third-party company, so another company, to determine the value of their company. And the third-party company does this by using a bunch of complicated math formulas and whatever derivatives, you know, like I'm not very good at math, to determine the company's value. Then let's say, for example, Google's value ends up being $100 million. Okay, so this is the capital. Let's say this pie chart right here represents the capital they want to raise and the value of their company, so the $100 million. And let's say I wanted to help them raise money and I wanted to buy a share or a fraction or portion of this pie chart right here. Well, it's up to Google to decide how many pieces they want to split this pie chart into and how many shares they want, right? So let's say they wanted to split this up into 100,000 different shares. Then we would take this $100 million and divide it up by 100,000 different shares of the pie. And then that would mean each individual share is going to be $1,000. Well, I'm not just gonna walk into the Google store and say, here's my money, I wanna buy into your company. No, I'm going to buy on something called the stock market where you can buy and exchange stocks. So just to reiterate, a stock is a fraction of ownership in a company. And you might be wondering, what's in it for me? Google's making all these big bucks, and what do I get in return? So the price of this original share, or this $1,000, will always be constantly fluctuating, and this is because of something called supply and demand. So let's say Google announced news that their company did really well and they have a new feature coming out. So this is good news, right? So because this is good news, more people think that this good news will overall boost up the value of the company, so that original $100 million will be growing and increasing. So more people will want to buy in and buy shares. So when demand goes up, usually the price is going to go up because more people want it, obviously. So the value of that original share is going to go up. So let's say Google announced bad news, hypothetically. I'm not looking for a lawsuit. And more people will think that because of this bad news, the overall value of their company, so that $100 million, will go down. And therefore, more people are going to be wanting to sell their shares because they think the value is going to go down. And therefore, there's less demand to buy more of these shares, and there's more supply. When there's less demand, the price is going to also go down, and the value, the original $1,000 of this share, is also going to go down. But the point in investing is that you want to turn a profit. So generally, you're going to buy into a share when it's at a lower price, so usually when the company does bad, and you're going to sell it when it's high, so usually when the company is doing a little bit better. So buy low, sell high. Remember those 4 words. As for what a bond is, it's not like a stock in which the capital is split into shares. Instead, bonds are issued by the government or also corporations. As for the government's bonds, they're called municipal or treasury bonds. Essentially, they say, hey, we need to raise capital, so they want to borrow money from you, the creditor or the debt holder. So when you buy a bond, that money that you use to buy a bond, let's say $1,000, they're actually using this money for their own purposes and using it to raise capital. So basically, they're indebted to you. So that company promises to pay you back that original investment, let's say $1,000, and it's also known as the principal amount or principal payment, plus a certain percentage of interest. These bond yields or interest rates generally fall between 0.5 to 3%, and on average, the maturity dates for these bonds are 14.5 years. Now, as for which one you should invest in, I would say if you're willing to wait a long time to turn a profit, bonds would be a good way to go as they're more safe and reliable and don't fluctuate like stocks. because the corporation or government will guarantee that this principal amount in interest is paid back to you. And there's a rate that's locked in. So these bonds usually have a specific rating score in terms of A, AA, BB, stuff like that, but that's a topic for another day. So just like on your report card, how you get A's, B's, and C's, but it's a little bit more advanced than that. But as for stocks, they can be bought and sold a lot more quicker, hence this thing called day trading, where you just trade it in a day. Although generally when you're starting off especially, you want to invest in stocks to buy and hold for a long period of time. So historically, if you hold your share in the S&P 500, which is an index fund, which is basically a mix of all the top companies' shares, you will get a 13.6 interest rate return in 10 years on average. Which means if you hold it for 10 years, you're guaranteed to make a profit at some point. And although stock prices do fluctuate constantly and on the day-to-day basis, the overall trend for, let's say, the S&P 500 is always upwards. So stocks do have higher returns in terms of profit, but with higher returns comes higher risk. Now, when you invest in bonds, because you're loaning this money out, you're the company's debtors or credit holders. So in the case of a bankruptcy, the people that hold a bond would get their money back first, as opposed to the shareholders, which is someone that has bought a share via the stock market. Now, I hope this video brings you more clarity as to which one you want to invest in, and take what you learned today and make your own informed decisions. So if you guys want to see more videos like this, make sure that you subscribe and keep in touch, and make sure you like this video if you enjoyed it, and it really helps me out. And also comment down your feedback and thoughts on what you want to see next. And that's it from me. See you guys.